Are you just starting out in trading and you're looking for ways to improve your trading returns? Well, if you are, then you're going to want to stick around, because in this week's video, we're going to be giving you 5 easy steps that will not only improve your trading returns, but it will make you a better trader in the process. So if you're interested in getting the results you want and becoming a better trader, then before we go any further, go ahead and hit the subscribe button. It doesn't cost you anything, but it does go a long way in helping us continue creating content that equips our viewers and subscribers to confidently participate in the financial markets. And also it acts as a bonus step that can improve your trading returns. Hello and welcome. My name is Dean Miller from Wealth Tip, where our tip for wealth is to trade, invest, and prosper. And in today's video, we're going to be going through 5 simple steps that, when taken, not only improves your trading returns, but it will also make you a better trader in the process. So starting off our list is the ASR, which stands for Advanced Self-Review. Now, I would like to clarify that although trading within itself has a lot to do with our own personal mental framework, this has nothing to do with the way we view ourselves in relation to the markets. ASR is a process by which you're able to record trade opportunities that is in line with your trading strategy and meets your criteria, but for some other reason you missed out on taking the trade. So basically, it's a record of all the trades that you've missed at any given time, be it a day, week, or month. Now, the reason we call this process the ASR process is because we have to document the specific reasons we missed the trade in the first place. For example, you might not have been at your computer at the time of the trade setting up, or you may have been in a meeting that when the trade came together, you weren't available. So either way, the idea behind this exercise is to come up with contingencies that will prevent you from missing another trade under similar circumstances, consequently missing less trades and ultimately increasing your trading returns. Now, having an updated ASR is all good and well, but it doesn't mean anything if you don't have a detailed, up-to-date trade journal. Many traders, especially those starting out, sees journaling as a chore instead of a process. But this is only because the concept of journaling isn't properly explained. You see, the reason we should journal, or we should keep a trading journal, has nothing to do with whether we win a trade or lose a trade, but it has everything to do with how many trades we win and how many trades we lose. And more importantly, what were the reasons we got into those trades in the first place? Now, when you have information like that, you have invaluable data that can be used to not only refine your trading approach, but it can also improve your trading results as well. So you may be wondering, exactly how does keeping a detailed, up-to-date trade journal improve your trading returns? And the answer can be summed up in one simple word: backtesting. Personally, I believe that backtesting within and of itself is the backbone of a good, profitable strategy and the key to trading with a carefree state of mind. So let me go ahead and explain this. So the reason I would argue that backtesting is a fundamental practice for a good, profitable trading strategy is because you're able to test a strategy over years worth of price action, and by the end of your testing, you can then determine whether or not you have a profitable formula, and that can make you money in the live markets without losing a cent and without wasting any time in the process. So I will also argue that backtesting is the key to a carefree state of mind, that once you are able to identify this particular trading approach, it gives you the confidence you need to know that you have a mathematical edge within the markets that will ultimately play itself out over time. So all you have to do is ultimately just trade according to your system, and the edge will play out on its own. So you no longer need to be obsessed over the outcome of any one particular trade, because you know that in order for your strategy to play out or outperform the markets, you need to trade it across a series of trades. So if you want to know if your trading strategy has an edge within the markets, you can go ahead and you can check out our Secrets to Consistency series. And that will give you a little bit more insight with regards to how we use risk management to determine whether or not you have a profitable formula. Now that you've backtested your strategy and you can confidently use it within the markets, you also develop the ability to forecast the probability or the probabilistic outcomes for each trade opportunity that comes together. When you're able to forecast effectively, you remove the element of surprise and you're able to accept the outcome regardless of what it might be. So you can only forecast effectively when you completely understand all the components that makes up your trading strategy, because it is these components that will allow you to plan ahead of time and ultimately stay 2 to 3 steps ahead of the market. Effective forecasting is like playing a game of chess. Before you can make a move, you need to know or need to determine what moves your opponent can make and then play accordingly. If you don't do this, then there's a good chance that you won't win the game, and the same principle applies to the markets. So when you forecast what the market can do, you can kind of plan or manage your particular trade accordingly. Just by doing this, you can ultimately increase your chances of getting the returns that you're looking for. So after you've taken all these steps, you are now ready to take the final step, which is creating a watch list. Now, last week I did make a reference to the importance of a watch list, and if you'd like to check out last week's video, then it would come up at the end of this one. But the main purpose of having a watch list is to ensure one thing, which is focus. There are thousands of instruments to trade, and if you're not careful, then you could get lost in the vastness that is the financial markets. So the best way to remain focused is by going through the various asset classes that you might be trading and flagging the ones that offers the greatest opportunity, and then only focus on those ones. So personally, I do my watch list over the weekend. This is because the markets are closed and I'm not necessarily distracted by any movements on the charts or news events that could change the direction of the trend. By doing this, I'm able to maintain my focus, but also able to see the markets clearly without distraction. And this does improve my ability to spot trading opportunities that could improve my trading returns. So guys, I really do hope that you enjoyed today's video, and if you did, be sure to leave a comment, as I would like to know what you think. Furthermore, I do hope that you will consider these steps and applying it to your trading process, because all it can do is make you a better trader and improve your returns in the process. So up until next week, keep well and bye for now.